What's up guys, welcome back to the channel. So let's talk worldwide debt. Now debt is something that a lot of people are scared of. It's something that can get the bailiffs to come after you and can actually be a really negative thing. But debt also allows you to buy things that you wouldn't otherwise be able to afford, whether it's a car, a home or a business. Going into debt through different loans or finance schemes is actually one of the most useful things you can do to maximise the money that you have. But worldwide debt is a slightly different beast to the debt that an individual like me might accumulate. Because at the end of the day, debt for an individual has a finite lifetime. You're going to die one day, and when you die, your debt will probably be written off, or your debt will be passed on to another generation, but that's less likely. More typically, the assets that you've accumulated over your life will be sold and they'll be used to cover the debts. Whereas worldwide debts and government debts, well, governments go on for generations and generations. So their debts can continue and there's less pressure for them to pay them off within their lifetime, because at the end of the day their lifetime may be infinite. So this means that you can get away with borrowing and borrowing and borrowing and building up debt to the point where it almost seems unmanageable. For example, the point we're in today, where the current debt to GDP ratio, that is the amount of debt versus the gross domestic product, so how much value there is in assets on Earth, is 3.5 times. So there's more than 3.5 times as much debt as there is value in assets on Earth. How is that possible? And what on earth does this mean for us? Are we heading towards some debt crisis? That's what I'm going to go into in this video. So worldwide debt has grown by over $15 trillion during the coronavirus pandemic to $277 trillion worldwide. This is an absolutely ridiculous sum. I mean, talk about Bill Gates and Jeff Bezos and how much money they have, and then think orders of magnitude greater. This is more money than the combined value of all of the assets on Earth. That's all the houses, all the mines, all the businesses, all gold, platinum, silver, all precious metals, everything else included. That's more money, 3.5 times more than all of that totaled. So who has all of this debt? Well, according to the Institute of International Finance, the largest proportion of this debt goes to non-financial companies. So these are companies that produce services and goods, for example Tesla, Apple, Facebook, and other private companies that are non-financial. Now these companies use debt to raise capital, to allow them to invest in different things, to grow their companies, or to reinvest into the ecosystem around them, or to improve their infrastructure, to improve the efficiency of their goods. But lots of companies operate using debt as a method of raising capital. Now the next biggest owners of debt is the one that gets covered probably the most in the media, and that is governments. Typically you'll see in the news how much the government have overspent on their budget, whether it's by a few billion for that year or whether a project is overrun. But governments in total around the globe total $63 trillion of global debt. And finally we have the last two categories of debt, which is financial institutions making up $58 trillion of debt and household debt making up $44 trillion of debt. So all of those total together is equal to your $277 trillion of debt. So how does all this debt come about? What form does it take? Well, boiling it down simply, debt is just when you're spending more than you're earning. So that means as an individual, if you're buying a house or a car that costs more than you earn and you take a loan out, you're in debt. If a business wants to finance a new factory, they may offer out debt in the form of bonds to raise capital to allow them to build a new factory. Governments can also do a similar thing, where they essentially promise to give you some money monthly in return for a cash sum up front, and you'll of course earn some extra interest on top, which is why you're incentivized to do it. But all of this creates debt. So as I said, debt is spending more than you earn. Now some of it's easier to spot than others. For example, buying a house that's worth £400,000 when you have a salary of £50,000 doesn't work out. You don't have enough to pay for the house up front, so you borrow from the bank. That borrowing that you've done is your debt. But of course, the money that the bank gives you isn't necessarily just capital that the bank has spare. That money that the bank loans to you is money that they have essentially taken from other people. For example, if you're putting your money into a bank account as a savings account, although you can just go to a cash point and withdraw that money at any point, what actually happens is that money goes into the bank and the bank invests it. So they'll either send it off and invest it into different people who are trying to get mortgages, so they'll pile together lots of savings and give them money as a lump sum and then give them a mortgage, or they'll just take that money and invest it into the stock market to try and get some return on their investments. And there are whole teams dedicated to exactly this process. Now, harder to spot debts are, for example, when companies issue bonds, because this is what's called debt financing. Now, it's something that's not very often covered and you don't really hear of it. Typically, when you're thinking of a company raising finance, you probably think like the Shark Tank or the Dragon's Den situation, where you trade a percentage of your company's equity in order to get some cash up front. So for example, if you value your company at £1 million, you may give away 20% of your company to an investor in return for £200,000 up front. However, debt financing requires you to not give away any equity, which is why it's beneficial to companies. What they do is they'll give you a bond which pays out a set amount plus interest every month, and then an investor will give them a cash sum up front which they can use to invest in whatever they need to grow the business. So this is harder to spot debt, but as I said before, financial companies and non-financial companies make up a large proportion of the debt, more so than household debt, which means that this kind of debt is the one that needs to be kept an eye on, as well as government debt, which can also be done using bonds in the same way. So who's all this debt to? Now, the short answer is aliens. No, I'm just joking. The short answer is us. Essentially, the way that debt builds up is that you write off liabilities against assets. So what that means is that if somebody takes out a loan to buy a house, that is tied down against the value of the house. So the house is the asset and the loan is then the debt that is accumulated. So for every liability, there's a tied against asset, right? Well, not quite, because then debt wouldn't be possible. You'd only ever be able to tie down assets to liabilities. The reason that debt can accumulate is that you can basically predict that people will pay back that money over time. So for example, if you borrow £400,000 to buy a house and you're earning £50,000 a year, you pay back £1,000 or £2,000 a month on your mortgage, then that's paying back the £400,000. So you don't necessarily have to be able to offset £400,000 immediately at the start, because you can predict that you'll get some of that value back over time. So debt, quite simply, is just a way of transferring assets into liabilities, and therefore is just a form of wealth. It's a way to increase your wealth over time, because you can use debt to increase your buying power. It's why people can invest in real estate that's way higher than the salary they make per year, is because you can take some risk and assume that they will pay it back over time. So that's who the debt is owed to. The debt is owed to us, it's owed to companies, it's owed to different governments, it's owed to individuals, and it's owed to asset holders around the world. But what does this mean for global debt? Well, as I said, assets and liabilities offset each other, and then you can create debt by increasing the leverage that the asset has by increasing the value of the liability. However, on top of this, you also have the ever fantastic thing of interest applied. So if it takes longer to pay off a debt, you'll have an interest applied to that, which means that you'll have to pay off even more, which means that the debt or the loan that you take increases beyond the value of the initial asset in the first place. So one good example of the impact that this can have in a real world situation is in the 1970s, if we look at what happened with oil, when it was decided that oil would only be sold in US dollars. Within 3 years, the price of oil had risen by 400%, which meant that oil poor countries had to borrow US dollars in order to buy oil for their countries. Now this was in the 70s. Then in the 80s, the interest rate on those loans increased to 20%. This meant that compounded over 4 years, those loans more than doubled. This resulted in a lot of oil poor countries who had borrowed those dollars not being able to pay back their debts, and in fact leading to a situation where their debt was growing more and more each year than they were paying off. An example of this close to home, for example, would be my student loan. So my student loan, when I left university after 4 years of a master's degree, was around £60,000. Now, I only pay back 9% of this over the threshold of £25,000 a year. So I'm only actually paying back a few tens, or maybe even £100+ per month. Whereas the interest on my loan is 6%, which means that my loan is growing by approximately £600 or £700 per month. So my student debt is growing faster than I'm paying it off, and in fact it probably will do for quite some time. Now, the benefit of student loan is that it doesn't count towards your credit score, and it's not necessarily the end of the world, it's just an additional tax. But that's one example of how debt can grow over time, even if you are making repayments of that debt. So applying that to the worldwide debt crisis, well, what's going to happen if people can't make the obligations to pay their debt? Well, we've seen debt waves around the world. They tend to happen in roughly 10 to 20 year cycles. It's happened in South America, it's happened in the Middle East, and it happened in the US in 2007 during the stock market crash. Now, this is something that we need to be concerned about, but may not be the end of the world and we may be able to avoid it. In the 2007 stock market crash, the housing market in the US collapsed, meaning that companies defaulted on their obligations to pay debts, and this led to a total collapse of the world economy, dragged down primarily by the US economy. The bigger concern for the worldwide debt crisis is that almost every country operates in debt. The result of this would mean that not only would the power of the US be pulling down, but the rest of the countries may begin to pull down. So if one country fails to make their debt obligations, then this could result in a knock-on effect of crippling the worldwide economy and causing not just a recession in the country that originally fails, but in a load of other countries as well. But it's not all doom and gloom. We can still avoid the debt crisis. Governments need to enforce debt restructuring to ensure that companies make their obligations to pay debts, and it's as easy as possible for them to do so. And also, we could look into the potential of a sovereign debt buyback scheme. So debt buybacks allow a third party to buy debt at a discounted rate off of an indebted person or company that may not be likely to meet their obligations to pay those debts. Now, the reason this is done is that the person or company who originally loaned that money wants to get as much of their money back as possible. If the person defaults on their debt payments, that means they stop making payments because they can't make them, then they'll get none of their money back. Whereas if they sell that debt at a discounted rate to another person who will pay all of the payments, at least they'll get a larger proportion of the money back than none at all. This can be done to reduce the worldwide debt burden, and may be possible to use different companies and governments that are in stronger financial positions to purchase debt off one another to reduce the overall load. So it's not all doom and gloom. There are ways out of this, and we're not necessarily heading for another massive worldwide recession like we saw in 2007 and 2008. But it's worth noting that a lot of very important financial analysers and financial journalists have predicted that the worldwide debt may reach a crisis point, and that we'll need to seriously reconsider how we function as a society and whether a debt-based society is still feasible. So that's everything for today's video. It may be a little bit doom and gloom, but hopefully there's a way out of this. I just wanted to inform you on something that is going on in the world and raise awareness of it. So thanks for watching. Like the video if you did enjoy, leave a comment letting me know what you think about the debt crisis and what videos you'd like to see in future. If you are new around here, consider subscribing if you like the content. And as always, I'll see you in the next video.